starting your career when the world is on fire sets you up with a certain mentality.
How do you think that affects the way you look at things?
I ask myself this question quite a bit. We were the first people to eliminate a guest policy. You want a guest? No problem. Bring them in. This is your home.
That's the reason why we want to be in the student housing market now.
Maybe people are looking at it totally wrong.
When things go wrong, they're going to go that wrong.
What makes you excited about projects and what makes you open that email?
If you've got something that jumps off the page,
It's fascinating to hear someone who's really been at the forefront.
Is AI here to replace people? No. Is it here to enhance performance? Or yeah.
Really interesting time right now.
Hi everyone, welcome back to Reinventing Real Estate with Harris Associates. I'm Jenna Harris from Harris Associates, head of co-living, and on my right is Jamie. He's joining us from the student sector, which he heads up at Harris Associates. And we're super excited today to have a very special guest, which is Russell Petrie from EQT Exeter, where he is head of student, and he has an absolute wealth of experience, been in the industry for 10 plus years. Obviously you wouldn't know it because he looks extremely young, but he has been around. We're super excited, and I suppose to begin with, it'd be great to jump into your experience up to this point, how you got here, and what were the milestones in your career that really shaped you?
Sure. First of all, thanks for having me on. You probably tell from the accent that I wasn't raised here. I moved to London about 15 years ago, straight after university. I got a job with a bank called Barclays. Joined 3 weeks before Lehman Brothers went bust.
Wow.
Oh, wow.
Very exciting time to join the finance industry.
Challenging time.
It was fascinating seeing reporters in Canary Wharf watching from our tower as bank people left with their 20-year careers and tatters and bankers' boxes to show it, and badges turned off. It was exciting times, but, kind of kept my head down there, managed to stick around through the various kind of cuts and calls at the business, and just happened into the real estate team. No real desire to genesis passion to get into real estate. Just somebody put me on a spreadsheet somewhere and ended up in the real estate team. But it was a great learning environment because, one, the market was very topsy-turvy. Got to see firsthand every sector, every refi, everything that was going on in the space, whether it's shopping centers or offices, or we were looking at data centers. We were doing kind of everything. And Barclays at the time was quite fortunate because it was one of the only banks that didn't take government funding. So we actually had a new loan book, whereas everybody else in real estate at the time moved from the origination team into the restructuring team, whereas we still did quite a bit. I think we were doing $2 or $3 billion of new loans every year. That's where I cut my teeth and probably got my first exposure to the student accommodation market. Weirdly, we had a relationship director there called Mark Quigley, who Jamie knows well, still also in the space, but he was really a pioneer and a champion of the student accommodation market in its infancy. And I think at one point he was providing 60% of all student accommodation loans in the space.
Incredible.
Paved the way for direct let lending in the space, which was relatively new at the time. Originally, the industry started where you had to have a university agreement to get funding. And Mark broke that mold, and he was sought after in the debt market. I worked on a few of those deals. There's a couple that are not far from here that we financed back in the day.
Which ones are those, Russell?
There's Fieldgate Street over there. We did a bunch of the original Nido stuff.
Oh, yeah.
Nido Portobello. And anything in that kind of 2010, 2011, 2012 vintage was likely financed by our team. And funnily enough, a lot of the people on that team are still in the student accommodation space as well. So we've all used that knowledge base and filtered out and still have at least a foot in the space. Barclays was a great learning environment, but it was pretty vanilla, I'd say.
Yeah.
And especially at the time with credit constraints where they were, the loans were pretty unoriginal and they were very safe. It didn't take long for me to start looking elsewhere. And I ended up joining the exact opposite, which was a startup, which was founded by a few ex-Barclays MDs, spun out, started their own advisory business. I was there for about 18 months, working up and down the capital stack, first exposure to kind of mezz, to equity, and all of that. Never really got the traction at that business. So I found my way to a company called Round Hill Capital, where I spent the better part of 10 years building the student accommodation business there. So again, very green, joining the team, first time on the buy side, plunged in the deep end on managing student housing assets, and never really left. I continued to focus on that sector as Round Hill's exposure and experience in the space evolved. So we started with 3 buildings in London. By the time I left, we were 10,000 beds in 6 different countries with full development capability. We had 35 people in there. I sat on the board of that business. So we were quite successful in that space. And that's about the time when I got approached by EQT. It had recently gone through a merger, and they were looking for more specialists to lean into the themes that they thought were most compelling and that they think have 10, 20-year life cycle exposure to. The business focus is on beds and sheds, mostly sheds. It's probably about 85% of our AUM is in the shed space, but resi and student is a growing piece of that puzzle. So I was brought in as head of student accommodation, European remit. We're a European fund that we invest out of. So it's really about building up the footprint in the European context. So at the moment, we have almost 3,000 beds in various states in the UK, 4,000 beds in Spain, and we have about 1,000 beds that sit in a separate vehicle in Ireland as well. So 3 countries. We've got stuff that we're working on in France, we're working on stuff in the Nordics. So again, trying to build up that footprint.
Just winding back when you first started in the student space, because at that time, the student space must have been so nascent, so new in so many different ways. How was your experience of the market at that point in time? Because I think it's fascinating to hear someone who's really been at the forefront throughout the whole industry and continues to be at the forefront of the sector.
One of the big differences was really, you had to explain what student accommodation was. It was unknown. And if you wanted to get planning, you had to go to the city council office and explain what student accommodation was, because everybody has, their mind immediately goes to their first year university experience, living in some terrible hostel residence somewhere. And they say, oh, that's what student accommodation is. Oh, you've got an agreement with the university, right? The university pays the rent. And what we do now is so much more evolved than what people who don't know the space have in their mind's eye. High service levels, well-designed rooms, a one-stop shop, pulling at all the stops to make it as easy as possible for somebody to rent that room, which increases value. And we have gyms and cinemas and study areas and all that kind of stuff. That didn't exist 15 years ago. The industry has evolved in a huge way. And we take it for granted today that every bank has a student housing specialist, more or less, in-house. That before we were knocking on the resi guy's door and he didn't really care. And we'd be going to get office specialists to understand, we've got 500 tenancies in this building, not 2, and they reset every year, and we got to resell the building every year. It's a very different dynamic. From my lens, over the last 15 years, various touch points in the space versus lender, now more as a principal investor, it's been fascinating to see that evolution.
Yeah.
And it's at the end of the day, students is quite a fun sector, because you're dealing with young people, which always bring a certain level of energy. It always keeps you on your toes because that age group is always evolving. You need to evolve quickly with it. I've seen buildings with lazy rivers and podcast rooms and all those kind of things that speak to a young generation. So when you're thinking about design, you're thinking about asset positioning, you're thinking about how do I optimize a certain building, including those elements is quite fun. What we were building 15 years ago was not pretty. They were very basic, quite cheap, and actually pushing through a little bit that kind of value barrier, still providing good value for money, but thoughtful design doesn't necessarily cost more.
You said about the student sector being incredibly creative. That's something that we definitely feel. What could this new project do? Or when we're working with developers, but always brainstorming new ideas, new concepts that then we can articulate to the market in a different way. And I think student is just, luckily, one of those sectors where you can really be a bit more playful and a bit more experimental with the services that you can provide. And you've obviously seen such a huge transition, but I think even in the 4 to 5 years that I've been in the student sector, I think there's been just a massive acceleration of real thoughtful design and sustainability and wellness and a focus around that really wasn't there 5 years ago.
Obviously, ESG as a talking point and as a focus of the market has really picked up speed in the last 2 or 3 years, 4 years, 5 years. And we're having conversations with people. Do you touch this ESG point? Do you touch that ESG point? What do you do about this? And it's interesting seeing, because in the student accommodation space, we do all this stuff naturally. Nobody had to regulate that we had to think about people's mental health and think about wellness and think about air circulation, think about overheating and thinking about how do we make the buildings super efficient because the landlord pays the utilities. We've always been on the forefront of that thought process. As regulations come down, the student accommodation sector really absorbs them. It's great to see the rest of the other real estate sectors catching up a little bit.
I think as well, like, it's incredibly interesting to go back, and we went over this point, but having started your career during a financial crisis, I think that must set you up to having a long-term view throughout all the kind of blips that have happened and the changes within the market, and must build resilience. How do you think that affects the way you look at things?
Yeah, I ask myself this question quite a bit because starting your career when the world is on fire sets you up with a certain mentality that somebody who started 3 or 4 years after me just wouldn't have seen that. They don't have the exposure to that. So when I found flipping from being a lender in the worst financial market we've ever had to a more principal equity investor, you need to flip your mentality as well. And as a lender, you're looking for every downside scenario. How do I protect myself, never lose a penny? And to be a successful principal investor, you have to have a glass half full attitude. You need to believe the world will be better in 5 years' time when you come to sell than it is today. Yeah. Without that, you will be unsuccessful. So I would be looking at assets to buy and deals to do and come up with an appraisal. And my colleagues would be like, no, you need to push those assumptions. We'll never get anything done thinking this way. And so it took me a long time to really get myself out of that mentality and that mode. And some people might say I've gone a little too far drinking the Kool-Aid.
Not so sure about that, Russell.
But I think there's certainly been a big mentality shift in that kind of underlying, when you've seen how bad it can get, you've seen the kind of waves of layoffs and the companies crumbling that have 150-year histories and all those kind of things. I think that sticks with you through your career. And I consider myself fortunate that I was able to experience it the way I did in a relatively low risk environment. There's a big difference between going through a massive recession when you're 24, when you're 34 or 44 or 54 or 64, different risk tolerances. And if I got laid off, I was starting my career anyways, I'll find something else to do. But that dynamic changes now, and you can look for similarities. And I think a lot of people in the kind of most recent, I don't want to say financial crisis, but call it macro shock with rising interest rates and inflation, I think they're looking for parallels in the global financial crisis. And, this has happened then in 2008, what's going to happen again now? And actually that thinking has been wrong most of the time. There's not a lot of kind of corollaries between the two. And I think that can be a little dangerous. As much as it's a positive because you've seen how bad it can get, it can be a little dangerous because you always think when things go wrong, they're going to go that wrong.
We were having a conversation actually in the office yesterday about this, and we were saying that when we're speaking to clients and they're asking us, you can't predict the top of the market in the same way that you can't predict the bottom of the market. But like we're saying to clients, it's opportunistic when you know that it's not at the top, allowing for there to be opportunity and take advantage of that opportunity. And I suppose that kind of leads on, and you just touched on it, about the rising interest rates. I know everyone was thinking we'd topped out on that and we were going to come off that top of the curve, but we keep going and possibly even more. How do you think that's going to affect investment?
I think what it's done is the tide's gone out and we're seeing who's swimming naked a little bit. The real estate industry specifically got quite complacent. It's easy to do real estate when base rates are low, when inflation's ticking over predictably. Everything goes the right way, and it was going that way for 10, 12 years, right? There was a long time where everything continued to be rosier than it was yesterday. I think this is where real estate investing, you can really separate the wheat and the chaff, because if you are a spectator or a tourist in a certain sector, and I use the student accommodation space quite a bit because 2-3 years ago, everybody was piling into the sector. Everybody wanted exposure. Everybody wanted to do it. And a lot of those people didn't know how to do it or how to think about assets in the right way. They just said, PBSA, 5 cap, great, let's do it. And I think those people that haven't maybe fully appreciated the dynamics of student accommodation, how operationally intensive it is, how it's a 12-month business. There's no sitting back. You're selling for 11 of those 12 months and you're selling every room twice every year. It's very intensive. And people in real estate are used to city offices on a 20-year lease to Deloitte and collecting rent checks. That's not what student accommodation is. People were too quick to jump in and didn't fully understand the risk or the markets that they were necessarily. Those are the people that I think are going to have the most pain. They built assets that were too fringy. They built product that looked great on spreadsheet but does not translate well to what we know students want, the price points that they're willing to transact at, in the different markets that they want to be in, and the kind of growth numbers in students and what universities are going to be winners and which universities are going to be losers over the next 5-10 years. All those kind of dynamics are at play. Generally, just bring it back to interest rates specifically, we've got a house view that it's going to be higher for longer. We don't crystal ball gaze. Inflation is, certainly we've seen in the UK, is more lasting than people had expected. And we're not in the business of trying to call the tops or call the bottoms. When things feel fully priced, we sell. When things feel cheap, we tend to buy. And fortunately at EQT Exeter, we are very thematic. So we do beds and sheds. We have closed-end funds. We have 3-year investment windows. So we've been very quiet over the last 12 months because the prevailing view was tomorrow it'll be worse than it is today. Things are going to get cheaper. And the worst thing you can do in real estate is buy something the next quarter it gets revalued down. We can't do that to our investors. So while we're not trying to predict the bottom, we are trying to layer in, average in a more buyer-friendly environment. And once we see that the dynamic has shifted to a price point that we are comfortable with, then we will be buying en masse again, where it's been maybe a little bit slow and we've been testing the market over the last 12 months. And I think our view that tomorrow is going to be worse than it is today is alleviating a bit.
Yeah.
I think it is, we're at a kind of a crunch point here where things feel like they're stabilizing out. The reactions in the swap markets to the 50 basis points increase recently from the Bank of England were relatively muted. That was already priced in over kind of the last couple of months.
Yeah,
So
quite.
there wasn't huge swings in that space. It was relatively known that it was a medium probability case. Now, how that translates into cap rates, which drives everything we do, is an important question. But we try to buy the best assets in the best locations for the best price we can. And I'm always of the view that I would rather pay up for the best real estate in the best markets rather than trying to be cute on a fringy asset that's at a super knockdown price that's only 50% let, because my experience has been it's much easier, or it was more defensive to be in areas where people want to be. And that's what real estate is at the end of the day. You need to sell something where somebody wants to be.
I think what's really interesting about what you're saying as well is there's this kind of potential moment in time where pricing becomes a bit more attractive and therefore you're looking at opportunities meaningfully again. But I suppose, I'm sure a lot of people would want to know what that potentially means to you at the moment and other investors as well. Is it yields moving out 5.75 for forward funds? Is it 6% in the regions? What type of territory do you feel is really attractive and would bring you back into the market in a meaningful fashion?
What we're always focused on is a yield on cost, especially in the more development frameworks. And you can simply look at the math. If we're doing, call it a 6% yield on cost, and we're borrowing at 7%, we have negative leverage and relatively low cash on cash, which means we need to make our stated returns not from income, but from capital value appreciation. And today it doesn't feel like there's going to, we're going to be making 10, 15% increases in capital values every year to hit our kind of 15% returns if we're making no money from the actual cash flow. There's the math of it. I would say where we've been more successful on more marketed bid processes is scenarios where we think we're smarter than others, or we see an angle, or we just love an asset in the location and we fully believe that asset will be heads and shoulders above the kind of rest of the market, especially if that asset is being rented in line with the rest of the market, which developers mostly do. They look at what are people selling for across the street, we'll use those rents, maybe put a little bit on top, but we're going to use that as our safe marketing basis. If we look at that and be like, that's 10% under rented, and we think it's going to have probably 2 or 3% above the market rental growth, just because this will be the dominant asset in that space and it has all the bells and whistles and great design and it's super prime location, we can convince ourselves that the growth case gets us to the math that makes sense.
So what you're saying basically is you believe in the premium rents if it's really best-in-class product, but the yield and the yield on cost is actually a lot more important to your IC. Is that what I'm hearing from you?
Again, I'm a sector specialist, so they rely on me to tell them what are the best assets. And if I say this is going to have 5% year-on-year rental growth versus something that's going to have 2% rental growth, they trust me to make that evaluation, which factors into the kind of yield on cost and how the market's going to evolve. But, if you are not a student specialist, you are a real estate specialist, yields and yield on cost is the kind of prevailing metric. And if your debt yield is lower, if your cost of debt is higher than your equity cost or the all equity cost of that building on an NOI yield, you're going to say something's wrong, right? Negative leverage doesn't make sense. The safe bank should not be making more money than somebody buying that building on an all cash basis, right? And I think where maybe we haven't been through this cycle long enough is, yes, that would make sense, but at least in the UK, in the resi space, we have unregulated rents. So we've been able to capture and prove that we can capture that inflationary upside. So maybe, let's say, the bank debt costs us 7%, 5% swap rates, 2% margin, 7% debt. You can still make a case for buying real estate at 5% if that 5% is going to grow 10, 12, 15% over the next 2 or 3 years per year to bring that back into equilibrium. Throw on some ESG initiatives, some refurbishment, refresh stuff, and just maybe a general reposition that building itself. You can build that case up of why that asset will be more successful than others. It's hard to say it's just got to be yield on cost. That's obviously a very important focus, but at the end of the day, it's buying great real estate at attractive pricing that even in a down market still makes sense.
I think it's this inflationary hedge element that everyone talks about in the student market, and that ability for you to every year rebase the whole building to capture the rent uplifts, to capture what's gone on in the environment, and also to benefit from hopefully chronic undersupply. The occupational market is frankly the best it's ever been in a lot of these kind of regional cities. And I'm sure you're seeing in your portfolio and some of the stats that are coming through that actually students are being forced to live in locations that aren't in those cities or much further out, and they're not being able to get access to accommodation, or if they do and they're lucky enough to get accommodation, they're having to pay significantly more for it. So that all helps with the investor and obviously the investor case that actually you're not just sitting on flat income, you are sitting on income that is going to accrue and accrue very positively over a period of time, because the tailwinds are that the demographics are saying to us there's going to be 400,000 more students by 2035, and there's going to be more international students, and the number of planning applications has declined dramatically over the past few years because of construction costs. So, all of these factors seem to be what people from our side are telling us that's the reason why we want to be in the student housing market now.
Anybody who listens, I'll preach all day about structural supply demand. We did a piece of work where we looked at how many students were added in London over the last 3 years. 85,000 new students came into the London market, and only 4,000 beds were created. And we have a building in London, and we can attest that every year over the last 2 cycles, they sell out quicker at higher rents than what they've done in the past. And that's just a function of there aren't enough beds to service that market. And quite frankly, I think it's great for an investor and as a landlord that those are the markets we want to be in. It's got to be extremely frustrating as a student, being relegated to the fringes of affordability, of attractive housing, and forced down to take these very difficult terms, very difficult areas that you don't want to live in because, frankly, there's just no other option. We've got to focus on areas where it's harder to build. We actively look for councils that are hostile towards student accommodation because those are the areas that will, over a 10, 20-year cycle, will continue to have supply issues. If you look at Bristol, which is one of our favorite markets right now, I think there's no beds delivered this year, no beds delivered next year, and then 900 beds delivered the year after that. There's quite a bit consented, but nobody can pull it out of the ground and make it feasible because of the construction costs are quite expensive. I think what we've proven in student accommodation in the last 15 years I've been in the space, there's tenant demand, yet we are still unable to get traction in certain cities to deliver for students. and they're just continually underserved.
Just quickly, out of interest, and I'm sure a lot of investors would want to know this question, is you mentioned your London asset and you mentioned there's been substantial rental growth and 100% occupancy since you bought it. But what sort of rental uplifts have you been seeing in percentage terms? Because I think that is quite helpful to inform underwriting and decision making from a London perspective, because I think often the concern and question is the yield in London is a lot lower, and therefore does it make sense in this current debt environment? But be useful to understand what sort of rent uplifts that you're seeing at the moment.
I couldn't possibly divulge our rental growth.
Go on, Russell.
Trade secrets. I can talk generally about it, and I would say if there was a building like ours, we've seen this year in that area, that submarket, 10 to 12% rental growth this year. And I think that is probably not pushing it as hard as it could be. I think if just the velocity of lettings that are happening in the area where we are, we'll probably do, or the area will probably see another 10, 12% rental growth the next year. I would caveat that by saying a good chunk of that rental growth over the last 2 years has been just catching up on utility inflation and wage inflation as well. So all your FM costs, all your contractors are more expensive. All your staff on site are more expensive. Your utilities. At one point, we were paying 8 times the utilities costs as we were 6 months prior, kind of pre-war.
That's mind-blowing, isn't it?
Yes, we're getting good rental growth, but because of the all-inclusive rental model, we were just catching up with our OPEX increases for that year. I'd say that was probably this current 22-23 academic year was probably the catch-up year. Everything else after that kind of drops to the bottom line because utilities are known and wages are not going up to the same degree. I would say 10% is very reasonable today. I've heard 15, 20% increases when people are really pushing. And even in like Bristol, 15, 20% rental growth last year. Would expect that again this year. So some significant rental growth that, frankly, we haven't seen in student accommodation. It's good that the student space has evidenced that we can capture inflation upside every year, which is why I think the space will be more resilient than others. The cap rates will remain tighter than others, and more people will come to the space.
If you imagine I'm a developer, how do I appeal to you? What are the 3 things you're looking for when you're looking to forward fund a project?
It's a bit of a cliche, but the location is always top priority. And we've got a bit of a saying in the student team that never underestimate the laziness of students. So you want to make sure you're in a transport node on campus, whatever that is, make it as easy as possible for people to get to university. Because I think a big part of our demographic is international students who maybe have never even been to that city. If I was investigating where I'm going to live, I would go, here's my campus, here's a few buildings, which one's closest, and start there. So if we can be in that catchment, that's obviously an important one. So we always focus on location, and we want to make sure the product that has been designed meets the needs of that location as well. So kind of location and product sit side by side. I think experience of the developers is an important one. There was a lot of people that are used to do offices and now are doing student accommodation because there's more activity in this space. You need to understand how to build a good, hard-wearing student building. At the end of the day, you trust the developer needs to be on site every day. When we're on site once a week or once a month, they're making 1,000 decisions a day on what to do in all these different areas. And if they're making the wrong ones, you end up with a kind of a flawed product. So that intangible experience is an important one for us. And it feeds into strength and balance sheet strength as well, the financial capability. There's a lot of forward fundings that were happening at the peak of the market there, where forward fundings were not providing any guarantee or support to backstop late delivery. And at the end of the day, opening on time is so crucial. Having somebody who can force through sheer will to get a building done when it's crunch time is important. And obviously, I think the kind of financial returns as well. We see a lot, especially now when people who bought land 2 or 3 years ago are now just getting planning approved. The construction cost environment is completely different. The yields are pushing out. Values are coming down, which means to make the numbers work on paper, you've got to really jack up rent and really tighten OPEX. And once that decouples from reality, you might be able to convince one person who's new to the space to pay top dollar for that. And maybe that's all they need. But for us, we know a lot. And we know when people are sandbagging the OpEx or pushing rent too high. Yes, we have a lot of inflation today, but that's not going to last forever.
Yeah.
So you need to have a relatively sensible approach to it.
I think it's really interesting what you say about us timers, because clearly we are in a market that's seeing quite substantial structural changes in the office sector, in retail and leisure and all sorts of different sectors. And we're getting a number of calls all the time and are representing several first timers in the student housing market, but developers that have got incredible gravitas and experience in the build to rent sector or the co-living sector or residential for sale sectors. And I think, as you say, it's like an educational process, but understanding that those people are able to really build up their experience and knowledge before they go to the market. And I think as a company, that's what we're really focused on when working with these developers. It's not taking out opportunities that, frankly, the developer doesn't really understand properly, or that they're looking at student for the first time, but they've actually lived and breathed the student market and they understand it, and they've maybe taken on several members of the team that have a bit of student experience. But I think what we're finding really interesting about that is that the student market is evolving because it's got knowledge from other sectors now.
Yeah, I was going to say, I think that's actually a really good point, because that outsider can actually challenge the product and bring a new lens to it. So I would say, yes, first timers can get it wrong, but they can also push the boundaries of what's actually happening. I know you've had a few clients in that space. I'm opening kind of their design proposals, and it's head and shoulders above what other people are doing locally, because maybe they come from a high-end resi experience and this is what they do, and they have that background, and maybe they can source materials or aesthetic or design better because they come at it from a different, maybe a hospitality lens or a high-end resi end.
I think that kind of hospitality lens is a really interesting one, because of course having a to-rent model, often having people viewed as kind of tenants, but now really evolving that into customers and clients. Whereas obviously in the hospitality space, that's always been the case. You've got a guest to stay, they're a customer, and how that shifts not only the expectation, but the deliverables in order to make sure that people are happy in the buildings and people want to stay there and they're going to recommend it to a friend. So I suppose that kind of shift is really interesting, and it must keep you on your toes, I can imagine, in terms of design.
I'll give you an example. I used to manage a building in Spitalfields. It was a 32-story tower, 1,100 beds, monster. And we bought it off. The guys who built it were pioneers in the space and built a really nice building. They did a great job with no blueprint. We took it over, and part of the thesis of why we bought the building was when you first walked into the building, the first thing you saw was turnstiles. You had the reception desk on the left and a security desk on the right, and it felt like a hospital waiting room. One of the first things we did was we got rid of the turnstiles. We got rid of the security desk because security sends the wrong message. We had concierge. They sit in reception at night, and they just wear the same t-shirts, but they're just more from a security train than a hospitality train when they're doing the 6 p.m. to 6 a.m. shift. We were the first people to eliminate a guest policy. You want a guest? No problem. Bring them in. This is your home. Those small changes, which didn't cost anything, immediately fed back, and that building started to really take off from that point. And frankly, everybody started copying us because those were easy wins to make that living stay much more appealing. We noticed all the guys down the street were getting rid of their guest policy. Student accommodation is one of those sectors where you need to have an intense focus on the client. Everybody talks about it. Not many people do it, and trying to understand who that individual is, how they want to live.
I really like that point that you make as well, in terms of changes and upgrades that don't cost anything, but they're just thoughtful.
Yeah.
And just putting yourself kind of in the shoes of a student, and how can we elevate their experience here, but not always thinking of it from a bottom line point of view. And actually there are huge changes one can make that have a big significant alteration on people's lives, but actually aren't costing anything. And I think that's something that's missed. How much do you think branding is a part of attracting students to new schemes?
It's absolutely crucial. If you come at it from a hospitality lens again, the look and feel, the sense of arrival, how your staff interact with your tenants is crucial. And I think we've always been very surprised at how important a strong building manager results in better bookings, better rebookings, better rental growth. And then when those good managers leave, we can actually see an impact on that. That kind of branding, that ethos, it's top down. So one organization who doesn't care about branding as much, doesn't ingrain it into everything they do and have kind of values-based operations, I think will do worse than somebody who does have a big focus on branding and takes pride of product and looks at servicing their tenants to the best possible way. I think you'll have winners and losers in that space. I think maybe if you think about branding nationally, I don't think you get much cross-pollination, because somebody who's studying in Bristol is not going to look at your building in Liverpool, is not going to look at your building in London, is not going to look at your building in Sheffield. The brand awareness doesn't translate like it does in hotels. If somebody can be a customer of the Ritz for 40 years, they're a student for 3. So you've got a very finite window of your tenant base. And yes, maybe they've got a younger sibling coming up behind them and said, I lived at this one, and if there's one in Liverpool and you should try the one in Newcastle, then yes, I think there will be some brand value there. With our buildings, we typically have more asset-focused branding, so build awareness around that asset itself, because at the end of the day, we want that asset to be known, and then we have multiple assets positioned in different ways in a given city, if we like that market, versus spending our energy coming up with some great national
Like
brand.
master brand, yeah. No,
But
that
going
makes
back
sense.
to that master brand, because I think that is quite an interesting thing at the moment. Obviously, your plan and previously at Roundhill was portfolio aggregation. So build a portfolio that's consistent, that's performing really well, that's high occupancy, that's stabilized, and then at some point in the future that you'll sell that portfolio. And I suppose the obvious question is, does that master brand, while it might not be necessarily accretive to students from what you're saying, in the sense of it doesn't have that same hotel affiliation, but maybe there's some benefits to it. But when you're talking to an overseas Singaporean fund or a pension fund or one of the eventual buyers of your portfolio, do you think that's a key benefit to create this kind of holistic brand and sort of story and storytelling around the concept? Because I think that is really interesting, certainly us, what we're doing is how do we create brands for buildings and for businesses and for concepts through our marketing campaigns that help investors like yourselves, but also longer term investors, to understand actually this is something I can really get behind and really attribute value to, and therefore get a premium price for?
Yeah, look, I think part of my view is a little bit of where we are as a firm in our evolution, right? We've got 7 buildings, 3 of which are operational, 4 by September. So we don't have the scale to invest into a central brand and operational function. Do I think if we had 10x the buildings we have now, it would be worthwhile? Absolutely. Like, we'd definitely be doing that because we want the control. And I think at that point you have scale to make it unlockable. Right now we don't have the scale for us to invest into a central master brand, have somebody else white label the operations. I think that brand just becomes a website and a t-shirt necessarily, because you're relying on somebody else's operational flow to make that successful. So until you're at a certain point where you can really embrace the full operational function and drive brand through that, it doesn't make sense to have a master brand, which is why we focus on the kind of asset brand basis. I hope our goal is to be at a scale where we do have a master brand, and we want to be one of the first people to do that across Europe as well. But that only comes with scale. So clearly the investors don't put much value on individual assets, like individual brands. But once you get a scale, then you can unlock portfolio premiums through that brand.
You're seeing from some of the content that we're producing, whether that's video or virtual reality or AR or even physical events and press, is that we're really concentrated on producing high quality kind of collaterals in order for investors to fully understand not only the design and the product, which is always seems to be quite different now than it ever was before, but also the micro location, and build this kind of storytelling approach around each and every sort of asset disposal, portfolio disposal, forward funding disposal, so that people like yourselves can get a much better understanding earlier on in the process of what this is all about, and therefore maybe it's fast tracks it or creates more competitive tension. So I think what's really useful from our perspective to understand from you is what makes you excited about projects and what makes you open that email, what makes you attracted to specific opportunities, knowing that obviously you've been in the sector for a long time, but what's the things that you feel like are the innovations and what needs to be done from an agency perspective to push the boundaries to get more capital into the space, but also the capital that are in the space to maybe pay more competitive prices or certainly get them interested in projects?
No, I think it's a good question because I'm a big believer that you eat with your eyes first, right? If you've got something that jumps off the page, if you've got the drone footage that puts it all in context of how this asset sits within the wider city market, we've got drone footage going through our buildings and some of our Spanish stuff. There's no point having a brand identity and a values-based kind of operations if you can't market that and sell it. And for us as an investor, that manifests itself. We invest in that brand and focusing on excellence at the operational level. We do that because we think it'll result in higher NOI or tighter cap yields. That is an important function for us. But if you stop there and when you come to market that asset to a next incoming buyer, you want to make sure that is jumping off the page and that story is being told. So having thoughtful, cohesive story from beginning to end, if you try to slap one on at the end, I think people will sense a little bit disingenuous. So tailoring that through the beginning, that starts at the kind of pre-apps in your planning process because that sets the tone for what you eventually get approved and what you're able to build. And if that is compromised from the beginning, you will do worse as you're trying to market that asset and harvest your investments. I put a huge factor on being able to that storytelling ability through the life cycle of any given investment.
Yeah, absolutely. I think what we find really interesting, especially at the moment, is that a lot of clients are approaching us and saying, look, we've done so much work in all of those pre-app stages, in the application, in the design, in the experience, in the events, in all sorts of things to actually make this mini business that we call student accommodation successful. But once we start marketing it to investors, we, put it in a flat PDF brochure and send it out to everyone with pictures that's not really bringing the experience of what we've spent 5 years creating to life. And that therefore reduces the probability of investors paying the tighter yields, the higher values, because actually they're not really understanding all the work that's gone in. And then our clients are getting feedback 5 years, 10 years down the line that actually we didn't realize what we were buying. And that's almost the worst feedback you could get from a marketing process, because that means that you're not actually getting the premium value that you need on that sale. So I think as an agency, that's what we're incredibly focused on right now, is how do we utilize all of our marketing capabilities, our marketing team and experience of other sectors, whether it's tech or hospitality or consumer B2C, and translate that into our very specific B2B market so that investors, whether they're in Singapore or US or in the UK, can really get to grips with it and get to grips with it quicker.
Again, one of the beauties of the student accommodation space, this is not a commodity. As much as people want it to be as like a homogenous investment sector, it's just not. Every building is different. Every local city and micro location is different. How that brand or that building interacts with students and tenants is different, and universities is different. This isn't German residential where it's all the same kind of thing. You buy thousands of units, they all look the same, and it's what's the yield? Okay, that's attractive. Let's do that. This is storytelling at its most fundamental level to a generation that grew up with TikTok and has an attention span of 3 seconds. So, if you can capture that attention, translate that into better, more profitable sales, which then leads on to a better NOI and a better asset disposal, you need to flow that storytelling through the full cycle, I think.
There, it's coming to that point about how B2C is really merging with B2B, and that putting all that investment behind your kind of B2C marketing and then almost detracting from that by having a kind of totally unparalleled pared back marketing for your B2B, but actually it's so important to be communicating what you're doing throughout the whole process, as opposed to making sure that consumers can see how fantastic your buildings are, but actually when it comes to showing off to other investors, you're quiet about it.
Yeah, I think you have to shout from the rooftops.
Yeah.
And again, branding and that kind of marketing, that storytelling works really well as long as it's successful. If it is not successful, it can work against you as well. But if you are able to unlock that, it can mean better asset value, because people feel better when they're buying it. If you show up to a building and it's good vibe, very high energy, you recognize that the front of house staff know everybody by name, you're going to come away with that investment decision, be like, I want that asset, which means more competitive tension, which means higher pricing, right? So I think that all flows through.
You know, we in student accommodation and also some of the other living sectors are very aware of the fact that there's new investors every day looking at this sector because they might be overweight in offices or overweight in hotels or overweight in retail or various other sectors. So it's a process of not only educating them on the building, but actually through the marketing collaterals, educating them on the student housing market as well. And I think that's where marketing does play that really nice role. Is this isn't a standard building. These are the reasons why it's attractive. And this is how it compares to the broader student market and why it's different and why you should be investing in PBSA versus BTR or co-living or something else.
I just want to move on a bit to the student demographic. And I think touching on domestic students now demanding more kind of purpose-built student accommodation, where previously it was obviously heavily weighed to international students. How do you think that's going to change the market?
I think international students will always be an important part because at the end of the day, PBSA is a premium product, especially the stuff that's been built in the last few years. Just the function of the construction costs mean that you need to charge somewhat high rents to make the numbers make sense, to have a return on your investment. And international students value what PBSA provides, which at the end of the day is ease of use, right? You can go in the Google reviews, you can go on the Instagram, you can check out the website, you can call somebody and do a virtual tour. You can, again, pulling out every stop for somebody to book. If you are unable to tour somewhere and your only option to where you're going to live for 12 months and pay 10, 15, 20,000 pounds towards sight unseen, if your only access is what's online, you're going to be attracted to those spaces that speak to that element. And PBSA versus a flat where maybe you don't know anybody or you don't know the language that well, or you don't know the cultural context or the regulations or the tenancy framework, you're kind of wading into the deep end on that.
Yeah.
Whereas we're very easy use. Yes, it might be a little bit more of a premium price, but it's easy and it's understood, and you have that kind of surety that what you get is going to be there when you get off the plane for the first time. So international students will always be an important part of it. But what we're seeing is, especially in the areas where there's more supply, is an increasing trend of domestic students actually coming out of traditional HMO product into PBSA. Now, I think that demographic is more price sensitive. So until you have enough saturation that the pricing speaks to a more domestic student cohort, you'll have difficulty attracting domestic students. But once you do, actually, the take-up is quite strong, and rebooking is quite strong because a domestic student might not think immediately that they're going to go to PBSA. I was that example. I wanted the frat party experience. You know, I lived in a house with 5 guys. We paid nothing and treated the house terribly, and that's the experience I wanted. I probably wasn't a candidate for PBSA. But once somebody comes into PBSA and they get out of that kind of framework and you give them a viable alternative that has a gym, has a cinema, has all their friends there, has 400 other students that they can interact with, has reception, somebody signs for the parcels, and it's only 10 quid more expensive a week, actually that's quite a viable alternative. I think domestic students are always worried that they're going to go in there and there's going to be CCTV and there's going to be somebody bang on their door at 9 o'clock if they're watching a movie too loudly, and it's going to be too big brothery. But actually the product, and if they give it a chance, is very viable. My prediction is that we'll see more and more domestic students choose PBSA, and especially if you couple that with kind of most councils want HMO stock for families. And so they're not renewing HMO licenses and they're actively pushing those houses to be refurbed into single-family housing. Again, where are they going to go? So there's that push-pull between what does somebody want and opening their eyes that PBSA is slightly more expensive, but much better value for money.
There's always sometimes critical moments with these movements or trends, and I think COVID was one of those moments where we saw people stuck in their accommodation and a lack of support from landlords, specifically in the HMO world, where you're a private landlord, you're not regulated, so there's not really much there to potentially do, whereas we saw a lot of PBSA landlords who are more institutional, more professional, providing those refunds. And then that gave way to the sense of there's more mental well-being, being part of a sense of community and checking in with a receptionist or with other students there and living through that experience. And then what we're seeing now is that the energy crisis and the backlash from that, and obviously the bills from that, has made the lifestyle of students living in HMOs a bit more uncertain. Not knowing actually what the bills are going to be at the end of the year, I think, is creating a sense of anxiety for students. And having the all-inclusive model that PBSA does provide seems to be, from what we hear from our clients, helping domestic students to move into the PBSA world, because it not only helps them from a mental well-being and community perspective, but also gives them that sense of understanding of, well, what is my all-in cost.
We've never had more inquiries on what's EPC, how insulated is your building. Students are very budget conscious. So when they got hit with big energy bills, they got very clued up very quickly on all things in sustainability and ESG, because it was coming out of their pocket at the end of the day. And then they learned PBSA is all-inclusive rents, and that's not going to change. And it's one flat rent versus a variable energy bill that, like you said, they don't know what it's going to be like. And those houses are usually in pretty poor nicks. You're paying above the odds for energy that is just going out into warming up the street. Yeah. I think it's been fascinating to watch how quickly young people have reacted to these sorts of things. And again, it's been a push from old drafty houses into modern PBSA buildings.
Now we're going to jump into our game section. What this involves is 2 truths, 1 lie. So what I'll do is I'll read out all of them, and then we'll go back and delve into each one, which one we think is the lie. So, to kick off, 18 million PBSA beds are required by 2033 to keep pace with demand. 2, there are 3.4 students for 1 bed in the student market in London. And 3, up to 5 billion of capital is waiting to enter the PBSA market. So should we jump into number 1, which is a huge statistic? I assume it's worldwide. 18 million PBSA beds are required by 2033 to keep pace with demand.
Where is that, globally?
Global. It's a lot of beds.
I was hoping it was the UK. I was like, that's wrong. That could be true. I wouldn't be shocked if that was the case, because there's 30 million students in Europe. I think there's 30 or 40 in the US. Throw in Asia, throw in Australia, Canada. And most places have demographic tailwinds where there's more 18-year-olds expected than there are today. So, I mean, it seems very high.
Yeah, it's a big
When you hear that number, it's
huge.
A big number, isn't it? But then, as you said, when you start thinking about some of the geographies, and even if it's in Africa or various other places, which we often ignore, or Latin America, and then you start thinking about what is classified as student housing and the whole world, it becomes a bit more potential.
So, yeah, I mean, it's a big number, but
It's a big number.
Yeah.
It's not inconceivable.
Impossible. And then there are 3.4 students for every 1 bed in the student market in London.
I think that's true.
Sounds pretty...
I thought it was 3.1, but 3.4.
It's in the realms,
Yeah.
isn't it?
Yeah, I don't think it's a trick question.
No. Yeah, no,
Such
that
a
seems...
chronic undersupply in London, isn't it? I mean, that just really pinpoints it.
And then the last one is up to 5 billion of capital is waiting to enter the PBSA market.
Again, I think that's plausible. There was a stat I heard, I think JLL came out with it last year, that there was 13 new JVs announced last year with billions of capital targeting the space. I wouldn't be surprised if that was true.
So which one is the
I think number 2 is true. I think number 3 is very true as well. So I think 1 is conceivable, but it's probably the weakest of the 3. So I'm going to go with number 1.
I'm a little bit biased here, but I think number 1 may be incorrect. It feels like such a big number.
So, to reveal, the lie is up to 5 billion of capital is waiting to
No
enter
way.
the PBSA sector.
And you're going to say it's 10.
It's more. I'm joking. I actually don't know what it is, but that is the lie.
Interesting. I bet if it's wrong, it's
It's
wrong to
more,
the low
yeah,
side.
yeah. Okay, great. So let's move on to our AI discussion. For everyone listening, EQT Exeter uses some AI tools, and Russ is going to walk us through a bit more about that. But one in particular that we thought was incredibly interesting was a function called Mother Brain. And one of those functions is that kind of filters through investment opportunities and puts them into a kind of order of priority according to what you are looking for. So that's a kind of incredible filtering system that's at your fingertips in order to enable you to be more efficient with your time and allocating your time to the right type of projects. But I'd love to hear more about how you integrate that and use that.
Yeah, I'd probably start by saying we don't use it enough. It's a great tool, and it's all built in-house. And I think EQT's focus on being a tech leader, one of the leading tech investors, but also ingraining that into what we do and making ourselves better, it speaks to the values and the ethos at EQT. I think we have 40 people on our digital team that all they do is do in-house tech initiatives. So we've got a self-storage business, for example, that we're getting off the ground, and we're building our own booking platform, and we'll be the first unmanned self-storage business in the UK because we're building the tools ourselves. So there's a lot of things that we utilize in-house and have access to that others don't, which will hopefully make us more successful in the long run. But Motherbrain's a really interesting tool, and it started as a filtering tool for our ventures colleagues and still to this day used in a big way. But over the years, it's just iterated on itself into adding more and more tools. We have every deal that we've ever looked at, all the due diligence that we've ever done is uploaded to that platform, and it can easily access it. We've recently added the more kind of conversational AI functionality. So you can say, tell me everything we know about telecommunications in Sweden. And it'll come back with thoughtful prompts and a summary of what we've done. And click here if you want to look at this deal or this deal, which might be relevant, and see what we said about that at the time, and maybe 3 or 4 years ago. But it's accessible. And we've been around since 1990, I think was when the firm started. So all of that data now to be harnessed at your fingertips is really helpful. It does everything from company selection through harnessing due diligence. And maybe we recently acquired a business in Asia called Baring Private Equity Asia, and it came with 20 billion of AUM. It's a leader in the mid-market private equity space. And because the maturity of our Nordic, European, and some US background, there's a lot of younger businesses in Asia that were kind of where, call it, Norway was 20 years ago with their telecommunications infrastructure. So what can we learn from how that evolved and apply that to South Korea or Vietnam or India and bring those lessons across? So again, having that kind of full suite of database and that knowledge sharing happening in a intelligent way through those kind of AI learning model functionality. So it's super impressive. We tap into everybody's LinkedIn contacts in the firm and all our kind of advisor network. Everybody uploads every 6 months. So if you need an introduction at a company and, Russell's roommate knows the CFO, you can track that through. So, somebody from Australia can call me to get in touch with somebody for a company for a guy that I went to high school with or something.
It seems like that is absolutely the way forward of how investment professionals are going to be sorting through, analyzing, underwriting, but also leveraging connections. As you said, you've got this incredible pool of people that are all working at this one company, and how do you use everyone's human relations and connections to actually benefit the whole business? And it might be that someone has a relationship that you've actually got no idea that they've got, but that then helps you get a deal over the line that you might not have had otherwise. So it's interesting because everyone talks about AI and they talk about the technology and the efficiency, but AI is helping humans to become more human in this context, which is actually really refreshing.
I think, you hit the nail on the head there in terms of AI is always seen as this replacement for human input, but actually the way that you're using it in order to actually leverage human relationships and acknowledging that those relationships are so key to our industry and saying, okay, well, we know that connections and knowing someone is a really great way of making an introduction, but using AI to support that as opposed to challenge that or replace that is super interesting. And maybe people are looking at it totally wrong. And instead of saying, is AI here to replace people? No, but is it here to enhance and increase performance of human input? Well, yeah.
I totally agree. The biggest problem we find is actually how do you harness AI? And there's so much data, so much that it can do. It's okay, tell it what you want, and you don't really even know how to fully unlock it. So I think we have to go through our own process of educating ourselves of how do we tap into these areas in an intellectual way. And then if there is gaps, I guess we're fortunate that we can plug those gaps with new tools or APIs or whatever it is to help with that. But it's really fascinating hearing the AI industry and all the headlines and then seeing it internally as a live use case. We're doing things like in our sheds business, or we have a few office buildings, corporate tenants. Somebody puts an inquiry for some relatively obscure South Korean company, and it turns out we know somebody who knows somebody who knows the CEO, and we use that avenue to try and be like, hey, make sure you rent this building. It's great. Let us know if we can help you. Humanizing, like you say, the business relationship. And I think, weirdly, real estate, even though it's bricks and mortar and quite physical, it's a people business. The winners and the losers are based off of the strength and quality of their relationships at the end of the day. And if you can harness these type of tools to enhance those relationships or make new ones, I think those are where we're going to really see win cases through AI adoption.
Russell, thank you so much for joining us. It has been fascinating, to be honest, walking through everything from your perspective on the market, how you're leveraging AI in the workplace and everything in between. So thank you so much for joining us and giving your insights. And to everyone else, we hope you enjoyed, and we'll be back with more episodes soon.